Hey everyone, welcome back to Corporate Decoder. Today, we're diving into Verra Mobility's latest 10K filing, their annual report. It's a long document, but don't worry, we'll decode it together. Think of this as trying to understand the rules of a complicated board game where the stakes are millions of dollars. It includes their financials, risks, and overall health as of the end of 2024, but we'll focus on the juicy bits. Is Verra Mobility driving towards success, or are there some speed bumps ahead? Let's find out. First off, what is Verra Mobility? In short, they're a smart mobility company. That means they use technology to make transportation safer and more efficient through things like toll and violation management, automated safety and traffic enforcement, and even parking solutions. Their business is broken down into three main segments. First, there's commercial services, which deals with fleet management. This segment made around $407 million in revenue last year. This part of the business helps rental car companies and other big fleet operators manage tolls, violations, and vehicle registration. Big names like Avis, Enterprise, and Hertz are among their clients in this segment. Next, we've got government solutions. This segment brings in about $391 million. This one focuses on automated safety, primarily in the US, Canada, and Australia. They provide things like red light cameras, speed enforcement systems, and school bus stop arm cameras. Finally, there's parking solutions, the smallest segment, bringing in around $81 million. This part of the business provides end-to-end parking management solutions for universities, hospitals, and commercial parking lots. Now let's check out the basic info. Their headquarters is in Mesa, Arizona. The document confirms that this is an annual report, meaning it's a comprehensive look back at the year's performance. This bit is key. The report notes that the market value of their stock held by non-affiliates was over $4.4 billion as of June of last year. That's a pretty big number. This gives us an idea of the company's size and overall value in the market. Moving on, is Verra Mobility doing well or not? Let's look at the numbers. Total revenue went up by about $62 million compared to the prior year. That's a solid 7.6% increase, which sounds really great for the overall health of the business. They also generated a healthy $224 million in cash flow from their operations, which is a good indicator of the company's ability to generate cash. They did use $200 million to buy back shares of their own stock. This can signal that the company thinks its stock is undervalued. However, there's a significant loss as well. They recorded a $97 million impairment related to goodwill in their parking solutions segment. Impairment means the book value is not recoverable. So it's as if they paid too much for an asset and now acknowledge that it isn't worth what they thought. Beyond numbers, let's look at the company's human capital management. Verra Mobility emphasizes attracting and retaining talented employees. They employed 1,879 people, with most of those being full-time employees based in the US. None of the employees are represented by a labor union or covered by a collective bargaining agreement, except for the 26 employees in Staten Island, New York. This can be good, depending on how it affects the company's operations. But it's not all sunshine and roses. The report outlines a number of risks that could affect the company. Like most companies, they acknowledge that bad economic conditions and industry downturns could hurt their business. They also admit they rely on a few key customers, and losing one or more of them could be a big blow. One huge risk they highlight is their contract with the New York City Department of Transportation, or NYCDOT. This contract makes up a significant chunk of their revenue, and it expired at the end of 2024. They have a short-term extension, but there's no guarantee they'll win a new contract. Losing that contract would definitely hurt. NYCDOT also had a large outstanding payment as of the end of the year. It accounts for around 17% of their total accounts receivable, so there is a risk of not getting paid on time. Speaking of government contracts, these always come with unique challenges. They're often subject to termination rights, delays in payments, and government audits. The audit findings could result in the contracts being reduced in price or scope or terminated altogether, as well as limit the ability to win new government work in the future. Another risk is a potential decrease in the acceptance of automated enforcement methods. If governments start restricting or banning red light cameras or similar technologies, it would hurt their government solutions business. Of course, cybersecurity is a concern for any tech-heavy company. A data breach or system failure could damage their reputation, lead to lawsuits, and result in costly penalties. As part of their core business, they process financial transactions, which contain personally identifiable information. They're also subject to a growing number of data privacy laws, both in the US and abroad, including GDPR and CCPA. Staying compliant with these laws is becoming increasingly complex and expensive. Operating internationally also adds complexity. They face risks like currency fluctuations, political instability, and compliance with different sets of regulations. Numerous countries also have agreed to economic cooperation and development model rules that propose a global minimum tax. They noted that due to global minimum tax rules becoming effective in countries in which they do business, subject to protective measures by the US, their taxes could increase. Protecting their intellectual property is crucial for their competitive advantage. Failing to acquire or adequately protect their patents, trademarks, and trade secrets could allow competitors to copy their solutions and steal market share. Finally, they have a substantial amount of debt, about $700 million in term loans plus $350 million in senior notes. This debt could limit their flexibility and make them more vulnerable to economic downturns. For example, they were forced to repurchase stocks in order to pay off previous debt as well as declare dividends to repay stockholders. Let's dive into their approach to cybersecurity a bit. Their board oversees the company's cybersecurity program, which is led by their VP of Cybersecurity and reports to the Chief Technology Officer. They use industry-recognized frameworks like NIST and ISO 27001, and they have strategies for risk management, incident response, and third-party oversight. They also invest in education and awareness programs to train employees about cyber threats. As of the end of 2024, they don't have any material risks from cybersecurity threats that have materially affected or are reasonably likely to have such a material effect. Regarding that goodwill impairment from the parking solutions segment, they point to recent performance that unfavorably impacted the parking solutions business, including lower revenue growth, higher customer churn, and lower profitability margins than previously estimated, as the reason for recognizing the one-time loss of $97.1 million. In terms of legal proceedings, the company has a big case with a court trial. There was a class action in Louisiana. If the company is not successful in the case, there may be a large impact on its financials. Lastly, they are referencing portions of their proxy statement to be filed in connection with their annual meeting of stockholders to be held May 20, 2025. We'll be on the lookout for that too. So what's the verdict on Verra Mobility? It is a company operating in a complex and heavily regulated environment. On the one hand, it's good news that their revenue is growing and they are profitable. On the other hand, their debt levels are relatively high, and a significant amount of revenue depends on a contract they might lose and a government that can change its mind on the core products that this company offers. They also made a good faith effort in their cybersecurity controls. I think that they are well positioned to navigate the complicated laws that exist as a service partner for both governments and citizens. Based on these and other factors, this could be a company poised for cautious growth. The stock is currently at $25 and I think is worth a look. Thanks for watching. Don't forget to like and subscribe for more corporate decoding. Let me know what other companies you want to learn about.